Hello, everyone. Welcome to the latest episode of Scrubbing the Skies, the webinar series of the Institute for Carbon Removal Law and Policy at American University. As always, I'm your host, Will Burns. I serve as the co-director, and I am really excited about what we're going to talk about today. Now, ostensibly, if you invoke the term insurance, for most people on the street, it's likely to induce somnolence almost immediately, right? But what today's guests are going to argue from a relatively new company called Kita is that insurance is likely to play or have to play a critical role in the business models of most carbon removal companies if they are to be viable and if we're to scale up the carbon removal industry to the requisite levels that the IPCC and others have said are necessary. So first of all, I want to introduce the principals from Kita, who will initially make a presentation, followed by a couple of questions that I will introduce to seed the discussion, and then we'll move to audience questions. So I want to encourage everybody at the outset during the presentation to start populating the Q&A box with questions. So today's guests are James Kench, who is head of insurance for Kita, as well as Racheal Notto, who is director of carbon market engagements for Kita. And so I'm going to ask James to step up and start with the initial part of our presentation. Welcome.
Great. Thanks, Will. Great to be here. Thank you for having us. We love this series and keen to always raise awareness on the insurance opportunity in the CDR space. So we are Kita. We insure carbon. We build insurance products to de-risk high quality carbon projects to enable them to scale. We believe insurance is the key, or one of the keys, to unlocking the institutional capital that the sector needs. Without insurance, it's hard to get the financing. And without financing, there's no project, and that's something we would like to fix. So the purpose of the webinar from our perspective is to share an overview on how carbon insurance can help de-risk the CDR sector, followed by the Q&A. I'll run through the agenda quickly on the next slide, and we'll cover sort of 15-20 minutes at a high level, but super keen to dig into the Q&A, as you said. The agenda is pretty self-explanatory, but we're excited to talk through the challenge of fungibility of carbon credits and how we can work through that in terms of being able to pay insurance claims in carbon credits. But to kick us off, so we're building insurance products to de-risk high quality carbon removal. Well, why is that? Well, like any industry, insurance isn't perfect. And in particular, it can be a bit chicken and egg. So new markets need insurance to scale, but it's hard to insure new markets. New markets are small, they're high risk, there's limited data, makes it hard to assess and price the risk, and that leads to no insurance, which is obviously a bad thing. So that's why Kita is here. We think carbon markets need insurance to scale, and it really needs a specialist company that understands the nuanced risks and opportunity to build those products. So we're thinking about how we build bespoke insurance products that solve some of the pain points of the carbon markets as it scales. And to do that, we really think about the entire life cycle of a carbon credit. We're looking at all the stakeholders, so both the buy side and the sell side, as well as the intermediaries and enablers. We're looking at all types of carbon projects, so we do focus on nature-based and engineered solutions and avoidance and removal, but we're super keen on the CDR space. We're already comfortable with biochar and enhanced weathering. Now we're looking at DAC, BECCS, and methane, and next we'll work our way through all the emerging technologies like marine CDR, etc. We'll go through our product suite later, but the risks we're thinking about from that perspective, a bespoke insurance product to help the carbon market scale. We're thinking about pre-validation risks, delivery risk, invalidation risk of issued credits. We're looking at the role of buffers and how insurance can be a complement or supplement to the buffer schemes. Thinking about a warranty backstop for intermediaries that have an implicit or explicit guarantee of the quality or existence of credits. We're looking at the political risk. It was sad to see there was not too much traction on Article 6 at COP, but we still think there's lots of risk there, and an insurance angle that can help de-risk investments overseas. And then there's things like traditional credit risk for project financing, and then the longer term reversal or durability risk, thinking around sort of wildfires on the forestry side or carbon leakage from underground storage, for example. So that's just a context on our vision and our mission. We'll just quickly explain about our structure and how we sit in the insurance market. So we're part of Lloyd's of London. They have an innovation lab. Lloyd's, if you don't know it, is a great place for specialist insurance, emerging risks, new risks. It's a place, the birthplace of insurance for things like cyber, space, and now carbon. We're also backed by a few major insurers and reinsurers, so we have two layers of support behind us. But I think the key point is we're really plugged into the global insurance markets, both here in the US and internationally. And we see part of our role is working closely with insurers, reinsurers, insurance brokers, and agents. So we really want to raise awareness of the opportunity in the carbon markets, build their appetite, and help create a market for this. Because as the financial scale up is going, there's going to need to be a commensurate insurance scale up as well. Insurance is quite a competitive industry, as like any other, but it's also quite collaborative. And many insurers and reinsurers will often participate together on the larger risks, a bit like a sort of syndication in bank lending. And the other last point to make before I move on is we think insurance is really on the front line for climate change, especially around managing exposure to natural catastrophes like hurricanes, floods, wildfires, and helping to improve resilience against sort of future events like that. And we think the insurance industry actually has a kind of key position of responsibility to ensure we as a society can understand those risks ASAP, and then we can enable the businesses and individuals to operate in this environment with confidence. So the key to that is risk management. So before going into insurance, it's useful to frame where insurance fits in. Risk management is very important because operating and building businesses involves taking risk. No risk, no reward. But the key is to have an awareness and understanding of those risks, and to act to either reduce, avoid, or transfer those risks where possible. And in this kind of classic framework we have up on the slide here, we think about risks in terms of frequency and severity. So how likely it is that something will go wrong, and what will be the impact financially when it does. We won't labor too much into the detail of this, except to say, working our way around these quadrants, when there's a low frequency of a loss and a low severity, that's probably a normal kind of cost of doing business. You break a computer monitor at work, you're not going to worry too much about it, but it's just one of those kind of little frictional costs that cut into your margin. When there's a high frequency event but a low impact, then that's critical to work on mitigating, reducing those events so they don't happen again. That might be if you have a more the risk of a slip or a trip by somebody visiting, you got to think about, how do I keep them all clean, but also want to minimize the risks that will happen to my patrons coming through. When it's a high frequency of event, but also a high severity, that's something you really want to avoid. And that's an unsustainable business model if that's something that you're frequently exposed to. Where insurance can play is in the low frequency, high severity events. And that's where you can transfer the risk by contract, either via indemnities from your counterparties, e.g. your suppliers, or risk transfer via insurance. And therefore we see the role of insurance in risk management is to take out that volatility. So insurance has two key dimensions, so proactive and a reactive. The proactive probably doesn't get much attention, but it's helping businesses and enabling businesses to take risks in the first place. And that's through risk assessment, mitigation, risk engineering. And then there's the reactive element of helping businesses recover after events. So being a backstop when things go wrong, to put companies and individuals back on their feet, minimize the downside risks. And also when we put companies back into a better position, to build in better resilience so that there's less likelihood of loss in the future. So insurance is a really key tool in this risk management framework. And we'll just dive into an example or some thoughts on the carbon removal side of things. So there's a bit of nuance in the carbon space because there's both the physical risks and the liabilities around the projects themselves, but then there's the intangible assets, the carbon credits, and there's some overlap between the two, but some are specific, and insurance can take this into account with different products and maybe different insurers responding to both in different ways. The risks to the physical asset or business liabilities are generally well understood, and I think the existing insurance market and industry is pretty comfortable there. You think your fire and theft for office buildings or manufacturing facilities, or insurance protecting against business liability, directors and officers, or workers' compensation. The risks to the intangible assets, however, are very nuanced, quickly evolving, and very new. And that's where we're looking to play, and it needs dedicated attention and bespoke solutions. And at this point, I'll hand over to Racheal to talk us through our thinking on that further.
Thank you, James. So this slide is to really paint a picture of the different risks that any carbon player could face, regardless if they're on the demand side or the supply side. And this is going through the carbon credit life cycle. So left to right, we're leading up to validation. Then you have the project in its continuous MRV stage. Then you have your credits that are issued, which can then be immediately retired, or they may go through multiple transfers between parties. So we look at it from the demand side and the supply side. There's a lot of overlapping risks, but each one and why a party might be concerned about it is quite unique. So I'll quickly go through some examples on this. So starting with that demand side, for investors that are trying to put new money into a new carbon project, they might be concerned about the validation risk of that project, such that this carbon project they're investing in doesn't even reach validation with the carbon standard. And that can happen for a lot of different reasons. So that's a pretty early stage risk that we see in terms of from that time of validation to credit issuance. There is a huge concern on the demand side of delivery risk. And we actually break that down into 3 different areas that delivery risks may be caused. So the first is counterparty risk, which is your fraud, negligence, abandonment, solvency. Second is your unavoidable risks, the ones that we all know and hear about, your natural catastrophes. Those are pretty impactful to any type of carbon project. And then the third bucket of risk that we think about is your carbon risk. So this is looking at more of the standards and methodologies. So not super likely, but the chance that a carbon standard goes insolvent, a little more likely chance that the standard invalidates a project, a little more likely chance that there's a major change in methodology, which then impacts the amount of credits that would be issued. That change in credits to be issued, obviously a large concern to anyone that's expecting a delivery of credits. And then finishing up the demand side. So after a investor, buyer, broker, whoever receives their carbon credits, then they obviously have a bunch of other risks to contend with around if the credit is invalidated post-issuance because something was wrong with the project, but that wasn't found until later. Anything related to claims, reversals, bunch of things. So huge on the invalidation side as well. Now, if we just quickly look over at the supply side, we break this down into quite similar, but again, it's different perspectives. So on the supply side, of course, the project developer is going to be really concerned about the implementation of the project. Again, that can come for a lot of reasons. Maybe they don't get enough funding. Maybe they don't get enough local support where the project is going to be based, a bunch of reasons. Going into the verification cluster of risk, this really mirrors the delivery risk, but obviously verification and issuance comes before the actual delivery. So what they could be concerned about and could be insured for is those natural catastrophes and some of those carbon risks as well. And then finally, of course, any project developer is going to be concerned about the reversal risk, and also, of course, directly related to that, the length of the permanence of the credits, because that is a huge component related to not just long-term impactful climate change or climate action to reverse climate change, but also that's a real business risk for them as it relates to buffers and how each of the carbon standards manage their buffers. And then no matter who you are, you're definitely going to be concerned about political risk and contracting risk as well. So we'll get into a bunch of these more as we go. But for now, this is how Kita really envisions our current live products against a carbon credit life cycle. So the top half of this slide shows your, same as the slide before, your 3 typical stages for a carbon credit, going from a project being designed and implemented, reaching its validation, and then it's operational, going all the way through its issuance, and then ongoing monitoring, reporting, and credit verifications. So that's how we really at Kita envision delivery risk, which is more on the demand side, but that's how we see delivery risk across the life cycle of carbon credit. And then on the chart on the bottom of this reflects how Kita's live carbon insurance products currently fill those gaps. So for pre-validation, we have policies that help with counterparty risk, the abandonment and insolvency issues. We also can do commitment policies to gear up for when a project is validated. Our flagship product that covers the space from validation all the way through first delivery of credit is our carbon purchase protection cover, which is a nearly all-inclusive policy for delivery risk that covers your counterparty risks, your natural catastrophes, and your carbon risks. And then also post-issuance, we're able to offer a product that covers fraud and negligence. So that is obviously only 3 products: fraud and negligence, delivery risk, and abandonment insolvency. I'm going to get a little bit more on the delivery risk, but also just to highlight, like James had mentioned earlier, we have multiple insurance products that we're working on. Political risk insurance, buffer insurance, warranties for marketplaces, and also some more really highly specified product developer insurance products as well. So those will be coming in 2024. And now we can go to the next slide, and I'll give you some more details on our flagship product. So carbon purchase protection cover. This is entirely for delivery risk, and this was our first product specifically developed for buyers and investors. And this really helps against, again, the delivery risk. So this covers your counterparty risk, that's your fraud, negligence, abandonment, insolvency. This covers your unavoidable risks, your natural catastrophes, and then it covers those carbon risks. The only thing this does not cover is political risks, which is why we're working to develop a separate product that is just for political risk. Just some key points to note about this is currently this product is available for projects that are in ARR, IFM, Red Plus, and biochar. Early 2024, we'll be moving into DAC, ERW, and mangroves. And like James said, we're really working to move into all technologies across the carbon spectrum as possible. And the other cool thing is that this insurance policy can go up to 10 years, which is a really quite a long insurance policy. We tried to make that as long as possible to really align with the credit verification cycles for projects. Most people that are interested in getting this policy, though, they end up landing in the 3 to 5 year long span. And one of the points you can see in here is that claims can be paid in cash or carbon credits. And on the next slide, I'm going to get into this a little bit more. So basically what happens is when a company decides they want to take out an insurance policy with Kita, this is any insurance policy, they have the choice at the time of binding that policy, if they have to make a claim, do they want the claim paid out in cash or carbon credits? If they decide that they want it to be paid out in carbon credits, then at the time that the policy is bound, we'll review with them what are the need to haves and the nice to have. So basically the same that you would expect anyone to go through when they're determining what type of credits they want to purchase or develop or engage with. So we look at a bunch of different attributes, including technology, methodology, standard, location, co-benefits, support of SDGs, price, CCP, alignment, rating from B0, Silvera, Renoster, Calyx, whoever. So we go through all those attributes, and the insured says it must meet these 3 criteria. And after that, if it could meet these other 3 criteria, that'd be great. So we agree on that in the beginning. And then if there's a claim made, KETA will go out to its carbon supplier pool, and we'll say, hey, we need these type of credits. Can you provide us all or some of this? And we'll do kind of, as you can see in the circle chart here, we'll keep broadening our search and expanding the criteria until we meet the claim amount that the insured is obligated to get. And then we'll take all those the credits that we've secured back to the insured, and we'll say this is best and final that the market can produce at this point in time. Does this meet your needs? If they're happy with it, they take the claim and the carbon credits. If they're still not satisfied with it, then, because obviously a lot of this is dependent on what's available at the market at a point in time, then they still have the fail-safe of being able to say, no, that still doesn't fit my needs. I'm just going to take the payout in cash instead. So we will get into discussion about this a little bit more during this webinar, but that's just a primer on paying claims and carbon credits. And on the next slide, as I close this out and gear us up for questions, just wanted to introduce the whole of the KETA team here. It is definitely more than James and I. James may be the face of the insurance, and I'm the face of the carbon, but there's a team of about 15 at KETA that is fully supporting these product developments and operation. And I'll hand it over to Will.
All right. Thank you so much, James and Racheal, for that initial overview. And so, as indicated, I just want to seed the conversation with a few questions. Encourage everyone to continue to populate the Q&A box, and then we'll move to those shortly. So, initial question I have is, Racheal, you averted to the proprietary carbon supplier pool that's used to potentially pay out for claims. So first question I have is what makes this pool proprietary?
Yeah, so that's a great question. And just to kind of give a little bit wider scope for the audience members that may not be as familiar with this, KETA has a carbon supplier pool. This is listed on our website. So any company that's in that pool, we like to have transparent display of who's in it. So you can go see who's in it there. And what we do is with this, for the paying claims and carbon, KETA is not taking any carbon credits on its books. We're working with these carbon suppliers to secure the best offers for our insureds to be able to pay out those claims. And I would say in terms of the term or the terminology around proprietary, that really relates to the fact that this carbon supplier pool, KETA is one of, if not the first companies to be able to pay claims in carbon credits. And then also this approach of using a supplier pool rather than acting as a clearinghouse for credits, where that relationship building to give us flexibility in the market rather than to have to take credits on our books is definitely the benefit of this carbon supplier pool.
All right. So related to that, I was looking on your site at the companies in the supply pool, and correct me if I'm wrong, but I think most of them are using forest-based approaches. So one question I have is, let's say that you are purchasing direct air capture or enhanced rock weathering credits, and in theory you're getting promised storage for 1,000 years or more, right? If what you're compensating with are forest credits, right, that necessarily are a lot less permanent and are also more subject to reversal, how are you providing like for like sort of protection?
Yeah, so that's a great question. Right now, just for everyone's reference, we have Everland, Chama, Archery, and Respira listed in our carbon supplier pool. They are definitely across the four of them, majority of their credits are in the MBS space. They do cover pretty much all technologies, but agreeing with Will, most of that is MBS. So they signed up, I want to say in July. They were our first onboard into the supplier pool. And I will be doing annual onboarding of new suppliers into the supplier pool to diversify it. And my next onboarding will actually be in January of 2024. And I have about 30 new suppliers that I'll be interviewing, going through KYC with, making sure they fit all of our requirements to meet the criteria of being in the carbon supplier pool, going through interviews and everything like that to add more suppliers. So I'll have to be done with that in March of next year. And that means we'll have a ton of new suppliers available that can provide a much wider breadth of technologies to the carbon supplier pool. So ideally, we will not run into a situation where someone needs a replacement of DAC credits and the only suppliers that are available are the NBS variety. We'll be expanding from that. The reason why we started with NBS suppliers is because for Kita's carbon purchase protection cover, that was the first product that we launched. And when that was first live, we only had the coverage for ARR. Then we expanded to IFM and Red Plus. So the true NBS suite. This is just based on interest within the market. But obviously we said we're going to move into DAC, ERW, mangroves, and keep growing. So our carbon supplier pool depth will match Kita's growth.
Okay. All right. So obviously one of the challenges is that we hear in the short term, right, that there's more demand than there is supply for carbon removal. But we all know that in the longer term, the real threat is that there'll be not enough demand, right, to scale up to the multiple gigatons that we're going to need. You cite carbon delivery risk as an impediment to companies purchasing carbon removal, and so I was curious what research supports that, and how salient a factor is that right now in terms of the pretty egregious lack of company purchases of carbon removal to date.
Yeah, so I can kick that one off and then James can chime in if he has anything else to add. But delivery risk in terms of on the demand side is definitely to Kita one of the biggest risk factors for getting increased forward purchases of carbon credits across all credit types and technologies, not just emerging like DAC or ERW or anything like that. So, and a big part of it is honestly, it does depend a little bit on the technology, but kind of referring back to the slide where I was talking about the counterparty risk and the natural catastrophe risk, and then obviously the carbon risk. So in the counterparty risk, we see this as a big impediment that investors are concerned about, where they understand the carbon markets. That's why they're an investor, not just a simple pre-purchaser. So they're comfortable with all the carbon risks, and maybe they're even comfortable with the immediate project developer that they're working with, but maybe the project developer has a different partner that's doing the on the ground work. And if that on the ground work doesn't go correctly, then of course no credits are going to get issued and then get delivered. So that's a big concern for counterparty risk feeding into lack of delivery. And then of course around natural catastrophe risk, I mean, 2023, again, hottest year on record, massive catastrophes around wildfires, floods, et cetera, et cetera. So, I mean, that's a huge area. What people typically think of for just MBS projects with the concern around the trees burning down. But also natural catastrophes can be really impactful to like a DAC plant or a biochar machinery, where the machinery could get negatively impacted as well. And if the actual physical thing, whether it be the tree or the DAC plant that is supposed to be creating the credits, is damaged, then again, that natural catastrophe is going to feed into a delivery risk. And then the third one, of course, is carbon risk, where there is rightfully so huge push and demand on the entire voluntary carbon market. being able to produce higher quality, more integrity carbon credits. With that comes emergence of new standards, new methodologies, adjustments to old methodologies. And as all of that is in flux, that is also creating concern where it's like, maybe I sign up for this project now, but what if that standard falls out of favor in a year? Or what if there's a major change to the underlying methodology in a few years? And again, those will also impact the amount of credits that would be verified to then get issued, which is what's rolling up into that delivery risk too.
Anything to add there, James?
So just to build on the physical risk side, I mentioned at the start that insurance is on the front lines for this. So I mean, we're obviously the first thought goes to the wildfire risk in forestry, but as Racheal mentioned, the physical risks for engineered CDR is not immune to that. And this year has been a record year for what we would call secondary perils in insurance speak. So classically, when you think about natural catastrophes from insurance perspective, we think of earthquakes, hurricanes, really big disasters. But this year it's been awful for severe convective storms. So things like tornadoes, hail, and flooding, which previously was kind of underrated a little bit in the insurance market, but the impact of sort of climatic events in the past few years has really, it's hurt the bottom line for the insurance industry, and now they're having to react and price that in, and it's only really directionally getting worse in one way. So definitely, not engineered solutions won't be immune, but at least it's there's some hope from an insurance perspective.
Yeah, and I'll add on one other point really quickly too, is a secondary impact of delivery risk is on the demand side, whether it's a buyer or investor. You'll see in the carbon contracts where they're pushing a lot of the risk mitigation tactics onto the responsibility of the project developer or the seller if they're not the same. And from Kita's perspective, pushing all of that risk, while understandable why the buyer investor wants the project developer to do that, is really an unfair risk management tactic across both parties. So that's all a secondary impact of that delivery risk, is then how you see different clauses and contracts being executed.
Makes sense. So one last question. So we focus a lot on insurance for buyers, but obviously you're also looking at insurance for project developers. And I saw that you've recently entered into an MOU with a project called Pyrex on biochar, and I was wondering if you could just briefly outline what the contours of that contract look like and what it's designed to do.
Yeah, sure. We're super excited about this one. So as we work our way through the engineered CDR technologies, we started with biochar because we see tremendous short-term scalability there. We did a deep dive into our underwriting model and getting comfortable with the unique risks of the biochar space. We also partnered with JECA to a strong biochar operator to kind of sense check and our due diligence checklist and keep us on track. And then with Pyreg, it's fantastic. So they're building this first of a kind leasing scheme to get pyrolysis machines into the hands of more operators more quickly, and then we provide help some de-risking for that to think of a way to risk off under delivery of projected carbon credits. So they'll be providing the machines to the operators. There'll be an upfront sort of payment, but also the carbon rights go to Pyreg, and then they're looking for off takers to sell the credits to, and then we'll be building an insurance product to put a wrap around that for non-delivery of the underlying credits due to the factors that Racheal listed below for our core delivery risk product. So super excited about that. And it has the potential to remove 4 million tons by 2050, targeting about 150 biochar projects in the next, by 2040. So massive scale up potential. And then when next on the docket is ERW. So hopefully we'll find equal opportunities there to announce soon.
All right. Okay, let's go to some of the questions from the audience. First one is, would insurance risks be lower if the carbon credit markets were regulated as opposed to voluntary markets?
Yeah, I can take a stab, and then Rachel, correct me if I'm wrong. I think that's the short answer is probably yes. I think we see the voluntary markets and compliance markets converging at different points in time in different jurisdictions to varying degrees. And then I think the advantage for us is we have that flexibility and agility to adapt our products to the risks as they emerge and to how the market emerges. If you look at the compliance markets, there are insurance products that are tailored to that. Everything's a lot more standardized, which makes it easier to price and build products around. So I think we would welcome that as it comes. But yeah, short answer is yes.
And I'll add on to that, that it's not just the regulation, it's the data too. So it goes into the highlight of 2023, talking about quality and integrity in the voluntary carbon market, but also the opposite side of that that's been spoken on is transparency and open data sources as well. The insurance industry, you can just think of them has a big data warehouse, and carbon specific data that's available to all is short. KITA is actively working to build that. That's what runs our insurance policies. But so the other thing I would add to that, it's not just regulations, it's also data, quality data, and open data.
Okay. Could you share a few cases where fraud has occurred involving carbon projects, except DAC or CCUS, they said, that you've encountered?
Yes, so I won't speak to one that KITA has specifically encountered, but in case a very classic example, actually not even classic yet, is the South Pole Kariba problems that came out through basically every news organization ever. And I say this in the nicest way because I actually formally worked at South Pole just earlier this year. But the Kariba project is a really great example of not just a perfect place where there was fraud going on with the on-the-ground project partner, CGI. So it's a great example where you can see a fraud and negligence product put into place. That's the Kariba project is also a really good example of changes in methodology. We've seen REDD+ methodologies change and the baseline requirements change many times. So that's another, the Kariba example is another good one for carbon risk related changes in methodologies. And then the other ones as well is because Kariba, the project is not sure if it has yet or will be, but it's still under investigation. So high likelihood that the project is invalidated, which means all the past credits might get canceled that were already delivered. That's obviously a huge risk on permanence and just any claims that were made. But then another huge component is the risk to the standard and their management of their buffer pool too. So, which is a good example for why KITA is also working to develop buffer insurance for carbon standards.
And I would just add that I think we see, we haven't seen direct examples in the cases that we're underwriting, but we would argue that insurance has a role to play in adding just an extra layer of due diligence. Because when we look at a project, we're looking at the physical risks, but also looking at the project risks, the financial track record, the credit risk of the developer, but also their operational track record. And sometimes, that will require a bit of a deep dive into the management teams and what's their track record. So there's been a few cases where there's a project we've had a quick look at which we weren't convinced of the integrity there. And that's important because when we're looking at insuring these products, we want to see an alignment of interest around why insurance is being bought, and it's not just being bought because it's the most high risk product. There's risk always, but we want to show that it's a robust project and that all the stakeholders involved, the investors and the developers, are doing everything with high integrity. So.
Do you think there's any risk, thinking about that, do you think there's any risk of moral hazard in this context where sellers will just say, well, then we're not going to worry about what we're purchasing or what we're claiming because we've got this insurance backup, right? The classic moral hazard concept behind crop insurance, for example.
Yeah, sure. And so part of our underwriting will be understanding who's buying and why they're buying it. Is it buying for their own account? And then what's the integrity around that? Is it, high integrity, long-term strategic player, very worried about, concerned about their reputation and doing the right thing? Or is it just, ticking a box to meet, a compliance need and not really caring about the outcome? And I think that then dictates, pretty clearly what their approach to the insurance will be. So that's some screening that we do look out for.
Yeah, and the issue of moral hazard is definitely one that we're cognizant, basically even from the moment we start talking to someone about their interest in taking out insurance policy. So it is definitely something that Keto takes very seriously. And it's also why not all of our insurance products are off the shelf. And we do a lot of bespoke insurance policies as well too, to help work around that and make sure that the policies are fit in the way they should be for the insured.
Next question. Are there any hurdles in expanding to blue carbon projects? As you mentioned, Kita currently only covers terrestrial projects.
Yes, I can
Not
start with
really.
that one. Go ahead.
I was just saying, yeah, not really. I mean, in a very simplistic way, we can think about them as wet trees. So there's a similar, delivery risk, execution risk of protecting what's there and regrowing or growing new saplings, etc. So I think it's more a case of just understanding the data. I think the longer term challenge around blue carbon is long term sea level rise and what impact that's going to have. But we do see, and there's a growing perception in the insurance industry about the role that mangroves have in coastal protections, which is good to see, and that's starting to be factored into coastal insurance underwriting for Caribbean, etc. Exposed properties. So Racheal.
I'll just add on that the key for Kita, anytime we expand into a new technology, like James said, is understanding the unique risks that come with that technology and adjusting our underwriting model, which is what we use to write our insurance policies, and making sure it accounts for those unique risks. So the nice part is for Kita, that's not a regulatory check mark that we need to get approval for. That's something we can just do on our own. And in that sense, we're very demand driven. So we expand by order of technology, by the type of demand that Kita is receiving for insurance. So that's why our next three are DAC, ERW, and mangroves, because we see the most demand for that. And the last thing I'll note is when we expand into a new technology, we like to partner with a technology expert on that. So our expansion into biochar, we did a lot of work, not just with pyrite, but also Jekka as well. So if there is anyone that is a blue carbon expert in any of the three subcategories within blue carbon that would like to see insurance expand that way faster, feel free to reach out to us.
Okay. All right. Next question is from somebody I know who is an insurance lawyer. So bear with me on the question because it has some detail. So financial responsibility insurance requirements in the U.S. have been a significant barrier to scaling CCS DAC with geological sequestration. The early U.S. nuclear industry in the 50s had difficulty scaling because of similar issues. Congress solved that problem in part by passing the Price-Anderson Nuclear Industries Indemnity Act, which created a shared risk pool and moved away from the polluter pays principle. Do you believe such policy changes would affect Kita's business model and general approach to CDR as a market opportunity? And if so, how?
Yeah, I can take a stab at that one. Good question. It's actually a topic of conversation. I mentioned insurance is collaborative. There's a group of insurers and reinsurers that are trying to get to grips with that question very much at the moment. I think it was aptly described as the elephant in the room by all insurers there, because it is it's the long-term risk that frankly the insurers aren't perhaps well placed to take. So I think it definitely everyone's cognizant of that risk. I think realistically, it's going to be some kind of public-private partnership, really, for something that's of that magnitude and of that duration. So, when you look at similar partnerships in other areas of insurance, like in flood risk or in response to terrorism, there's a sort of a partnership between, say, the US government and the US insurers here, or in the UK, similar pools, and it's building building a kind of box where private insurance has a role to play, but knowing that there is a sort of government backstop for the very large, almost uninsurable risks that we kind of alluded to at the start there. So definitely when everyone's thinking about it, they're keen to act, but it really is going to be a struggle, I think, to find a private insurance product for very long durations for the magnitude of cover without some type of partnership like this. And how will that affect our business model? I mean, we're focused more on the credit side, so we would see that kind of long-term reversal risk, not on the direct side. So maybe not if there is seepage or leakage of carbon and the direct kind of physical impact or environmental liability, but we would see how that feeds into the credits that are derived from that, and maybe the invalidation of those credits, and thinking about how that might impact into the buffers or in the supply side, and how our insurance products would make that whole. I think that's manageable at a sort of credit level. I think at the underlying physical and environmental liability level, that's where it's going to need some partnership.
Yeah, I like how the question before that and this one connect in some ways in terms of ultimately what the role of government will be and what the impact will be. So it'll be interesting to watch those developments. So the next question is one I wanted to ask too, which is roughly how much can a buyer expect to pay for this insurance? I know these are bespoke policies and there's lots of different conditions, but I was wondering if you have any way of conveying what this looks like.
Yeah, I can take a step. I mean, if you're super keen to know, then reach out, and we're happy to talk on live cases, because it really does vary depending on the bespoke nature of the risks. I mean, I won't give figures, but I'll just say our ballpark goal is we model the main risk around the delivery risk insurance around default rates. So a lot of the developers are early stage or SPVs. And we model that, and that's the main driver of the risks, as well as the physical risks and the carbon risks. But that sort of counterparty credit risk is the priority, and that's how we base our model and pricing around. So we would argue it's analogous to the types of credit insurance policies that investors and banks are naturally looking at as part of their sort of risk management approach in emerging markets. But reach out if you'd like to learn more.
Anything to add to that, Racheal?
I was just going to say that the types of policies also matter, because on the lower side, if it's a very well understood technology, let's go with ARR, moderate policy, all the counterparties check out, that's going to be on the lower side, versus something like our upcoming political risk policy, where especially at COP just closed and there was no progress on Article 6, or a policy like that, because it is covering things that are so volatile and high risk, it's going to be on the more expensive side too.
Yeah. Again, another example of where ultimately, if there's government regulation and buy-in, including at the international level, right, it'll have an impact ultimately all the way down the chain. So yeah, it's interesting. Next question. Do you expect soil carbon projects to be insurable within a reasonably affordable policy for buyers and or suppliers?
I can pick that one up because that's another response related to developers as well. So for us going into soil or anything in the regen ag space, that is akin to the earlier question of moving into blue carbon, where it's all about us, Kita, internally understanding the unique risks to that technology, to the technology globally, but also in specific locations too, because all of that, the location of the project obviously has a huge impact for especially NDS-based projects. So in terms of expansion into it, that shouldn't really change the affordability too much compared to any other delivery risk policy. So moving into soil and regen ag broadly is definitely on our radar for expanding into technologies as well. And the other thing that I'll add to on the developer side, and this actually isn't just soil, but most commonly see it in regen ag, is where there's a project, but then it's across multiple farms, which are all different small landholders, which may or may not even be connected. And there's one project proponent, project developer. But if anything goes wrong with a few of those small landholders, those farmers, then that can impact the entirety of the project as well. So we're also working on insurance policies that support the small landholders and the project developers, which could be very impactful for Regen Ag, IFM, and also potentially some cook stoves. No promises on how that develops. It's very tricky one to tackle, but that is something that's hopefully on our late 2024, 2025 roadmap for an additional policy.
So I have a question that's kind of related to that, so I'm going to jump to that first. Is there you were talking about things like cook stoves, right? I think that's what you said, wasn't it?
Mhm.
Did I? Okay. Is there a certain size of project that's required for a policy to be available?
Our minimum actually is not on the size of the project, it's on the value of the insurance policy. And currently, our minimum is £50,000
Hmm.
GBP. So it's less on the project size. And this is actually for very similar reasons of why we don't look at policies as a price per credit, rather a total financial value, because there is a lot of variation across those two dynamics. And yes, those are hugely important aspects within the carbon markets, but within insurance, because again, we're driven by data and risk management. We have a lot more flexibility on accounting for those points. So yeah, there's no minimum size for a project. It's about the minimum value of the insurance.
Yeah. And I'll just add that at the moment, because it's such an early stage emerging market, everything's very bespoke, everything's very tailored. As it becomes more standardized, commoditized, and there's more volume, then we expect that sort of minimum to go down. So it would be easier to manage smaller deals once there's more certainty and consistency between the transaction structures and as we get more data on the risks themselves. So
Makes sense. Um, Next question. How does community engagement factor into insurance rates for storage sites or CDR in close proximity to communities?
yeah, I can kick off. I just want to say first, thank you. I mean, over the summer there was the Carbon Business Council organized the carbon symposium in DC, and Will was with the carbon law and policy team, and I thought that was a fantastic workshop because that great learnings for me, and we brought that back to the underwriting team, and we see that as just a fantastic checklist of what one we should be doing anyway. I mean, we all should be reviewing that in terms of what is the right thing to do, but also feeds really nicely into what does good look like in terms of community engagement, and good engagement means more sustainable projects and lower risks. So I thought that was a great event. And then the Carbon Business Council have released a sort of online training that we kind of ensuring all our underwriters go through that to kind of equip them with those tools. So great piece of work there.
All right. So for some of the newer technology-based carbon removal pathways, how large of a carbon pool are you expecting there to be that isn't under contract already if there's a general low supply? Do you think there'll be enough to cover delivery risk of contracted supply?
Hopefully, yes. That is going to be my proof in the pudding come Q1 next year. But also, one of the reasons why we at Kita are not too concerned about it is because it's based on when a claim is made, and because, like we said earlier, our policies can go up to 10 years, and carbon insurance is still very, very new. So those claims are going to be in quite long windows, which means we'll have a lot of time to react to a claim, make sure that we have the right credits available in our supplier pool to be able to fill the insured's need. The other kind of component to that as well is with, especially on the emerging technology side, for at least for us for the next 5 years, we're not too concerned because the types of insurance that we're looking at in that space for the actual policies, it's for a pretty low count of carbon credits. Obviously, as we know, the typical contract done for a CDR, for a tech CDR, is looking at like 1,000 credits. So pretty small in terms of volume, and because we're working with ideally what will be a breadth of suppliers, we can pull across suppliers to add up to the amount of credits that we need per claim, per technology, and kind of work through it that way. So if I've done my homework, yes, we'll be fine. But I'll hopefully find out in March.
Yeah, it sounds like a bit of a chicken or egg sort of thing, right? Where ultimately these barriers mean we don't have enough of this, but to get there, yeah. So
Yes, yes, absolutely. And then, of course, obviously changes in the market price of credits is going to
yeah,
impact that claim amount too.
yeah.
So that's also something we're very cognizant about.
Okay. Next question. Is there insurance for finance that supports purchase of carbon credits, such as something that's akin to mortgage insurance?
Yeah, and that's one we're working on. I think that there's two elements there. There's what we would call traditional non-payment credit insurance. So, if a bank's lending to a developer, um, there's insurance for just the non-payment of that loan, and that's something that we can look at on a case-by-case basis. But I'm keen to take a carbon CDR expert lens when it's a developer that's on the lending side. I think what's also interesting is we're seeing banks and larger institutional investors come in with large investment funds. They're looking to lend those to project developers in certain CDR types, and then they want to secure that lending via the future stream of carbon credits. So they'll have kind of dual recourse over the repayment of the loan, but also maybe a recourse to the credits if the loan is unpaid. And we're working with a few banks at the moment on structuring what that carbon credit insurance product would look like. But I think that's going to be interesting, and it's fairly bespoke facilities to start with. But again, once we've done it once and the bank's done it once, then it'll be fairly easy to rinse and repeat, hopefully. So starting off in looking at enhanced weathering, potentially in methane capping, working with developers in that space. So watch this space, but definitely one within our appetite and one that we see opportunity for.
There was a question I'll answer in here, which is whether the recording will be available for this, and the answer is yes. We archive these; they're generally available about a week after we record these on our YouTube site. People were asking about the PowerPoint for this, and I guess I'll encourage them to contact you at Kita, and I'll make sure that your email address is in there because obviously you get to decide if you're going to disgorge that. So, next question. Ray Blue Carbon, given the extent of uncertainty about how SLR will affect blue carbon habitats, how are you working to constrain that risk? Any particular modeling tools or statistical tools you view as useful?
I don't know what SLR is. I would expect that this would actually be a really great question for our CTO and data analyst, Nancy. Both of them work with an extensive network of data vendors that are technology specific for exactly these types of questions. So that is a question that if you would like to reach out to me with it, I can connect you to the right guy and lady that can answer your question on it.
All right.
I
And there
think
were,
I think
oh, go ahead,
I was,
James.
I was just going to add. I think the key for any of these new risks, there's ways to understand it, but it's just kind of working out what is the information we need to know and what are the data sets that are out there, and then you can stitch together different data sets to get a kind of comprehensive view of the risk, which you won't be able to buy that off the shelf. But I think for us, that's the key kind of USP for us is going away and working out how the heck do you underwrite this stuff. And sometimes you learn as you go, but there's I think increasingly really great data sets out there that you can marry with the traditional cat modeling softwares and tools that we have in the insurance industry. So
Right.
I don't think it's beyond the realm of possible for sure.
Yeah. But the flip side of it might be, right, with some of these, like the MRV is pretty imposing still for enhanced rock weathering, for example, and certainly for the ocean-based approaches. Could it be that the risk is so high in terms of the even the methodological veracity down the road that it would be cost prohibitive to be able to get insurance for at least at the current time for some of these?
Yeah, but I think the play is to not the insurance doesn't need to solve complete, the whole problem. Again, it's just taking out that volatility. So if the insurance industry is very uncertain about a particular risks, then they may say, well, we'll insure this, but we're not going to insure it from the ground up. You as the insured needs to take the first X million or X percentage of the loss, and then but if there's a really really severe loss, then we can get comfortable. Then over time, that's how you sort of slowly the insurers dip their toe in the water, but get more comfortable with those types of risks. So it might be um, that's one play. I think the other angle is there's in insurance. There are no bad risks. There are just bad pricing. So that there'll be insurance available. It's just whether it's going to be commercially acceptable at that right attachment point. So just kind of playing around with those two levers, I think.
Okay. All right. We are at the bewitching hour. So I would like to thank once again Racheal and James for a great presentation. And as always, I love our audience because this is, to put it mildly, in the weeds, right? Uh, in the blue weeds, in the biochar, whatever analogy you want to use. But we've got a community that's really thoughtful about these questions, and it's just really helpful in terms of working these things out. So I'd like to thank the audience also for their thoughtful comments. We will be back next week. Last webinar for the year, focusing on CDR developments from COP28. Most likely on the 19th. Hopefully, we'll have an announcement today. I know we're pushing up perilously close to the holidays, but for you real CDR nerds, I hope some of you will show up. So thanks everyone once again, and goodbye now.
Bye-bye.